Hello and welcome to the Economist Board for our September 2024 Watch Report. I'm John Nelson with M&A. We're joined by Keith Prather of Armada. And in this video, we're going to spend some time taking a look at overall industrial production and the two key components going into that supply chain, which is primary metals and fabricated metals. And for our subscribers, we're going to dive a little bit deeper then into the industrials as well as housing, private non-residential construction. We'll dive into the whole supply chain or the moving portion of the supply chain, all the trucking and rail, etc. So, and then the final piece, you kind of wonder, well, why are we taking a look at consumer spending? And the reason we do that is because that covers about 70% of GDP. So we'll also take a look at consumer spending when we take a look at our macroeconomic outlook. So I'm going to shut up for a second. Keith, how are you doing today?
Yeah, doing great. Doing great. Ready to talk about this economy and everything else that goes along with it.
Oh boy, that just made me get all excited.
Yeah, there you go. There you go.
All right, so let's jump over. We're going to go ahead and pull up industrial production for manufacturing, and away we go. And Keith, as you can see, the story kind of remains the same for IPMAN. If anything, it's like half a percentage point flatter, but essentially the same story we've been saying all along. I don't know if you would call this a soft landing or just kind of flat. I mean, because there's just not a lot of movement for the next 18 months.
Yeah, absolutely. I don't know if you want to jump to the next one real quick and we can talk more about it.
Yeah, absolutely.
Because I think the long term, kind of shows it historically there. So well above the trend line, you can see the dotted black line is the long-term trend, and we're still way above that. And if you kind of let your eyes follow across, you can see that, if we do hit the projection next year, we're going to be near some historic peaks over the last, 15 years or so. So still from an overall production or overall, volume perspective, it's still going to be a pretty good environment. Now, some of the backdrop here, John, is kind of interesting because globally, when we look at global manufacturing activity, we're not quite officially calling it a global recession for manufacturing, but the slowdown is dramatic. When you look at what's happening in Europe, you look at even some of the slowdown throughout Asia, you look at definitely the slowdown in the USMCA markets. The US looks like we're probably going to be at the end of September dipping a little bit deeper into contraction. So some of the flash PMI readings that we got show the US maybe as low as 47 points. A reading of 50 would be sort of the break-even point between expansion and contraction. And last month we were right around 48 points. So it looks like we may have lost some momentum even in September, but we always have to wait for the final data to come out. We'll get that sometime next week. And then we'll kind of see where that's at. But on a global basis, there is definitely a manufacturing slowdown. And we do see it also reflected in our model, at least through, the second half of this year or the end of this year, and then kind of accelerating a little bit into next year.
Okay. I got one question for you. Why do you suppose there's a little bit of a different outlook here in the United States than globally?
Well, and I don't know that it's a different outlook so much as we don't get a lot of outlooks for the rest of the world. We're projecting 18 months ahead, and typically the United States is kind of a lead lag kind of market. We tend to lead a lot of other global growth markets, but sometimes we can lag in the sense that there are times when the Asian markets will decelerate or the European markets will decelerate fast enough that it does eventually pull down on the U.S. and it will drag us lower. But typically we're the lead here, and so I think you saw the general slowdown in the United States taking place early in Q2. Some would even hint that maybe start as early as Q1, and then we continue through Q3, weakening and seeing it pulled a little bit lower. And now we see the global markets reacting to that. You and I, we talk later in the non-residential construction sector about the growth of U.S. manufacturing construction and how significant that is. And a lot of that capacity will be coming online, over the next 2 to 3 years. And as it comes online, we're going to start seeing the industrial production numbers for manufacturing in the U.S. actually go up. and they may go up independently of what happens in the rest of the world. In fact, the rest of the world may suffer a little bit because, we're doing more localized manufacturing here in the United States, and that pulls some of the global volume off the market. So we may see global PMIs get a little bit weaker, even though US PMIs are continuing to improve a little bit.
Gotcha. Okay, well, let's take a look at the supply chain. We'll start off with primary metal. Relatively flat for about the next 12 months, slight increase, but then kind of diving off the end there at about that 10-month mark, and doing a little bit of a drop. Now, we've been calling that for about the last couple months. It's softened a little bit. What we're calling, so I wouldn't read too much into things past about 10, 12 months. I'm fairly comfortable with that. And if we were to take a look at the long term, you can kind of see what the implication of that is. Even though it's a drop off, though, it's still a drop off closer to trend, overall. So your thoughts, sir?
Yeah, it's kind of interesting. And again, this model, I didn't say this when we had the IPMAN model up, but the IPMAN model right now is batting about 98% accuracy 6 months out. This one's almost 96%. So we're pretty confident in the next 6 months of the forecast. Now, that drop off in the back half is fascinating. So there's a backstory taking place in the primary metal sector right now. The Chinese government and the Chinese economy is in a little bit of trouble. Economically, it has been decelerating significantly. And one of the maneuvers that the Chinese government can pull from time to time, which is nothing wrong with it necessarily, but it's a factor we have to deal with, is that they will buy at a federal level or at a government level a lot of raw materials around the world, especially when they're inexpensive. So they'll stockpile things like copper, nickel, aluminum, whatever that commodity is. Then when economic conditions get weak, they can take those raw materials and they can sell them inexpensively to manufacturers to be able to open and keep a lot of those assembly lines moving. So you'll see a lot of manufacturers building a lot of intermediate products, and those intermediate products then are being built without a customer in mind or without a customer order in hand. And so they'll take those intermediate products and they go flood the global market with it. And so you're seeing a lot of countries right now pushing back, especially with copper, especially a little bit with steel and some other primary metals, just because of that flooding of the market. So you can see some near-term weakness overall in commodities, but typically that's followed by, 4 to 6 months later, a bit of a surge. And so none of that is built into this particular model, right? None of the things I just talked about are included in it. But the model is sensitive enough and it uses enough indicators that it's fascinating that it's picking up on that potential when you look at what happens mid next year.
Mm-hmm.
So let's assume the globe consumes all of this excess metal that's being hitting the market over the next 6 months. You kind of get into the middle of next year, and all of a sudden the globe is kind of weak on those commodities, right? We've gone through those materials. China has already pulled its punch and used all of its excess resources. And so where do you have to go after that then to go find resources? You're going to be using primary metal production in the US and other places to be able to fill those supply chains. And so that surge that we get kind of middle of next year is entirely plausible, right? I can explain it with what I see in market conditions and the data showing it to us. The drop off then is kind of scary though at the end of 2025, and that's a little tough to explain at the moment.
Mm-hmm.
I don't know if it's picking up some previous cycles and think that those are going to repeat, but from an economic perspective, we should be building momentum. So I think for you and I, we're just going to say that we think that the back half of that curve may start to improve and actually will come back up.
And it actually did improve by about a point or so from last month. So I was starting to see that movement on the back half. So that gives me from the math side what I think might happen.
Okay, all right. Sorry for the long explanation, but I think
no, but that all makes sense.
Okay.
All right, so here let's take a look at fabricated. Now, fabricated takes a little bit of a different story. This one, there was definitely some movement. It's still positive in terms of being growth, but boy, it pulled back quite a bit on its longer forecast. Still very bullish, I guess, for the next 12 months or so, but that steep slope and ending up closer to 110, if just by comparison, if you take a look at the upper half of our curve of variability there, or cone of variability, for this month is about what we were saying for last month. So you can see how much this model shifted just in 30 days.
Yeah, unfortunately, I mean, it is it is a significant deceleration on the back half of that curve. You
Yeah.
can see it there really well. It does continue to accelerate up to the 100 level. So if you're comparing it to the last 5 years, it's going to feel good. But if you're trying to compare it to pre-pandemic levels, we just don't return to those pre-pandemic levels. Now, I think with a lot of the reshoring of a lot of manufacturing activity, there's going to be a demand for fabricated metal production locally. We think about fabricated metals as one of those key inputs into most other manufacturing assembly lines. So you think about automotive, airlines and aerospace, anything in the heavy machinery manufacturing sector. All of those are fed by things that happen in the fabricated metal product sector. So that's going to continue to be a key driver, I think. And so as we see more onshoring of U.S. manufacturing, it makes sense to try and kind of procure fabricated products locally rather than trying to go to the global market and get them. So I think we will continue to see this curve improve over time, especially as some of that new manufacturing capacity comes online over the next 2 years. But yeah, it is a little concerning that the general economic fundamentals are pulling the back end of the curve down a little bit. And I think, again, that's some of the weakness that we're seeing across machinery, automotive, aerospace, and some of the other sectors. And if you tune in and watch all the other videos, you'll kind of hear us talk about that in those sectors.
All right. Well, thanks, Keith. And that concludes our look at the overall industrial production for manufacturing, top level, especially in the durable goods. So we hope to see you again next month.
Thanks, everybody. Everyone stay safe. Take care.